You ever notice how Americans can stay calm during almost anything? Political chaos, market crashes, even toilet paper shortages. But mention interest rates and suddenly everyone's pulse spikes. It's almost like the phrase itself has become a trigger. People hear interest rates are rising and immediately imagine their dreams getting more expensive, their debt growing heavier, and their financial future slipping just a little further out of reach. And the truth is, they're not entirely wrong. Something big is happening right now with interest rates, and even if you're not paying attention, it's already affecting your wallet in ways you might not even realize. Because interest rates don't just impact banks. They don't just influence investors. They quietly touch almost every part of daily life. Rent, groceries, mortgages, credit cards, job opportunities, savings accounts, and even the decisions businesses make about hiring or firing. The thing is, most people only see the obvious effects, like higher loan payments, but they don't see how deeply this has started shaping the entire financial outlook for millions of Americans. And that's exactly why people are scared. Not because they fully understand what's happening, but because they can feel the consequences without being able to explain them. It's like the economic version of seeing storm clouds forming, but not knowing whether it's going to drizzle or destroy your roof. To really understand why interest rates have so many Americans on edge, you have to go back to how we even got here. And this is where most people check out because the topic sounds boring on the surface. But the story behind it is actually one of the wildest financial roller coasters in recent history. Imagine going from a world of nearly free money, where borrowing felt easier than ever before, to suddenly finding yourself in an environment where every financial decision carries more weight. That's basically what happened. Not slowly, not gently, but in a sudden shift that caught millions off guard. For years, Americans enjoyed historically low rates. Mortgages were cheap. Credit card debts, while still painful, were far more manageable than they are today. Car loans didn't feel outrageous. Even big companies used cheap money to grow rapidly, hire aggressively, and fuel the economy. When money is cheap, everything feels possible. And for a while, it was. But then inflation happened. Fast, aggressively, and in a way that forced the Federal Reserve to slam on the brakes. That's when the rates started climbing, and they kept climbing until the average person could no longer ignore the change. Suddenly, home buyers found themselves priced out of the market, not because homes were more expensive, though they were, but because the cost of borrowing had multiplied. Debt that once felt manageable now felt like quicksand. The dream of home ownership, already difficult for younger Americans, started to feel nearly impossible. And older Americans, relying on credit or loans, felt the pinch even harder. But here's where it gets even more interesting. Interest rates don't just make borrowing more expensive, they change behavior. They influence how Americans spend, save, invest, and even how they think about the future. People are tightening their budgets. They're questioning purchases. They're putting off major life decisions like buying homes, starting businesses, or even going back to school, simply because the cost of financing those choices suddenly became intimidating. And you might have noticed this shift everywhere. Maybe fewer people in your city seem to be shopping like they used to. Maybe you've heard coworkers talk about slowing down on spending. Maybe your own budget feels tighter, even if your income hasn't changed. That's the hidden power of interest rates. They reshape the economy not just through numbers, but through human behavior. The fear Americans feel today is rooted in uncertainty. We've reached a point where people aren't sure whether rates will fall soon, keep rising, or stay painfully high, and uncertainty is one of the most uncomfortable financial feelings anyone can experience. When you don't know what's coming, you hesitate, you pause, you stop making moves. And when millions of people do that at the same time, it slows the entire economy. But let's get specific about how all of this is showing up in your actual wallet. For most Americans, the impact starts with credit cards. We're talking about interest rates that have hit some of the highest levels seen in decades. And here's the thing, credit card interest is especially painful because it compounds, it stacks, it grows in the background while you're busy living your life. A small balance can turn into a stressful monthly payment shockingly fast. Americans are feeling this every day, especially those who rely on credit to cover basic expenses, a group that has grown significantly as household costs rise. Then there's housing. This is where the anxiety really ramps up.
Mortgage rates spiked so dramatically that a home that once cost $2,000 a month to finance can now cost $3,500 or more, even if the price of the house didn't change. That's not a small difference. That's the kind of number that pushes people out of the market entirely. Many Americans who were saving and planning for years suddenly had to step back and rethink everything. Some had to give up on buying altogether. Others chose to wait, hoping the rates would drop. And then there are those locked into low-rate mortgages who now feel trapped. They can't move, can't refinance, and can't afford to sell because buying anything else would push them into a much higher payment. But here's where it gets even more interesting. Interest rates don't just make borrowing more expensive, they change behavior. They influence how Americans spend, save, invest, and even how they think about the future. People are tightening their budgets. They're questioning purchases. They're putting off major life decisions like buying homes, starting businesses, or even going back to school simply because the cost of financing those choices suddenly became intimidating. And you might have noticed this shift everywhere. Maybe fewer people in your city seem to be shopping like they used to. Maybe you've heard coworkers talk about slowing down on spending. Maybe your own budget feels tighter even if your income hasn't changed. That's the hidden power of interest rates. They reshape the economy not just through numbers, but through human behavior. The fear Americans feel today is rooted in uncertainty. We've reached a point where people aren't sure whether rates will fall soon, keep rising, or stay painfully high. And uncertainty is one of the most uncomfortable financial feelings anyone can experience. When you don't know what's coming, you hesitate, you pause, you stop making moves. And when millions of people do that at the same time, it slows the entire economy. But let's get specific about how all of this is showing up in your actual wallet. For most Americans, the impact starts with credit cards. We're talking about interest rates that have hit some of the highest levels seen in decades. And here's the thing, credit card interest is especially painful because it compounds, it stacks, it grows in the background while you're busy living your life. A small balance can turn into a stressful monthly payment shockingly fast. Americans are feeling this every day, especially those who rely on credit to cover basic expenses, a group that has grown significantly as household costs rise. Then there's housing. This is where the anxiety really ramps up. Mortgage rates spiked so dramatically that a home that once cost $2,000 a month to finance can now cost $3,500 or more, even if the price of the house didn't change. That's not a small difference. That's the kind of number that pushes people out of the market entirely. Many Americans who were saving and planning for years suddenly had to step back and rethink everything. Some had to give up on buying altogether. Others chose to wait, hoping the rates would drop. And then there are those locked into low-rate mortgages who now feel trapped. They can't move, can't refinance, and can't afford to sell because buying anything else would push them into a much higher payment. But here's where it gets even more interesting. Interest rates don't just make borrowing more expensive, they change behavior. They influence how Americans spend, save, invest, and even how they think about the future. People are tightening their budgets. They're questioning purchases. They're putting off major life decisions like buying homes, starting businesses, or even going back to school simply because the cost of financing those choices suddenly became intimidating.
This brings us to the emotional side of why interest rates scare Americans. We often talk about finance like it's purely numbers, charts, and economic policy. But financial fear is deeply human. It's based on the way money shapes identity, lifestyle, and personal security. When interest rates rise, people start questioning decisions. They feel uncertain about their future. They feel pressure. And that pressure collects quietly, like weight on your shoulders. People don't walk around saying, "I'm anxious because of monetary policy." They just feel stressed about money and don't always know why. But even though this environment feels tough, and it is tough, it's not all negative. Some people see rising rates as an opportunity. Savers, investors with cash on the sidelines, and those willing to be patient can benefit from a market that's slower, calmer, and less frothy than the one we saw in past years. In other words, while rising rates close some doors, they open others. It's not about panicking, it's about understanding the environment and making smarter moves inside it. What most people don't realize is that interest rates are not random. They're not unpredictable. They follow patterns. They respond to economic conditions. And while they affect nearly everything, they also create opportunities in nearly every corner of the financial world if you know where to look.
Understating this is the first step toward not letting fear control your financial decisions. And it's important to remember, the purpose of interest rates isn't to punish anyone. They're a tool the government uses to control inflation, stabilize the economy, and prevent things from spiraling. They may feel painful in the short term, but they're part of a bigger effort to prevent long-term damage. The key is recognizing what's within your control and what isn't. Before we continue deeper into what rising interest rates mean specifically for debt, savings, investing, and your long-term financial goals, it's important to remember that everything here is meant purely for educational purposes. This is not financial advice, and your personal situation may be very different from the average American's. So, with all of this in mind, and now that we've set the stage for how big of an impact these rising rates have across the board, we can start diving into the details of how these changes directly shape your wallet, your purchasing power, and your financial decisions. To really understand how interest rates are squeezing Americans today, you have to look past the headlines and zoom into the everyday decisions people are forced to make. Because the truth is, rising rates don't just tighten budgets, they reshape lives. They change how people plan, how they think, and how they behave with their money. And while some Americans are adjusting, many are still caught in a financial environment they weren't prepared for. The shift wasn't gentle, it wasn't gradual. It arrived quickly, loudly, and at a time when the average household was already dealing with higher grocery bills, higher rent, and a cost of living that hasn't given them much breathing room. One of the biggest areas where this change has been felt is the credit system. For years, Americans relied on cheap credit to fill gaps in their budgets, to manage emergencies, and sometimes just to keep up with the rising cost of basic necessities. But now, the cost of using that same credit has exploded. When your credit card interest rate climbs into the 20s, or in some cases the high 20s, you're no longer just borrowing money. You're entering a cycle that punishes you for every extra day you carry a balance. Americans who once felt comfortable managing their debt are now seeing balances rise faster than they can pay them down. And that creates a very real sense of panic, even if people don't show it. What's more alarming is the number of people turning to credit cards just to cover essentials. When the price of everything from groceries to gas goes up, people naturally look for ways to bridge the gap. For some, that means cutting back. For others, it means using credit as a temporary solution. But when interest rates are this high, a temporary solution becomes a long-term burden. Every swipe becomes more expensive. Every unpaid balance becomes a bigger problem. It's no wonder Americans feel like they're drowning. They're borrowing in the most expensive environment they've seen in decades. This pressure also shows up in auto loans. Cars have always been a significant financial commitment, but rising rates have turned that commitment into a burden many people didn't expect. A car that once cost a manageable monthly payment now comes with loan terms that stretch the budget to its limit. Some people are paying more for interest than they are for the car itself. And while demand for new cars has cooled in some regions, many Americans don't have the luxury of waiting. They need reliable transportation. They need a way to get to work. They need a vehicle for daily life. But the rising cost of financing that vehicle is making what used to be a standard life purchase feel more like a financial gamble. Housing, though, is where the real emotional weight hits. For many Americans, owning a home has always been part of the dream, a symbol of stability, a long-term investment, a step toward building wealth. But today, that dream feels increasingly out of reach. Even people with good incomes find themselves struggling to qualify for mortgages that used to be a given. Not because the homes dramatically changed, though prices are still high in many areas, but because the cost of financing them has skyrocketed. Imagine saving for years, preparing your credit, doing everything right, only to find that your buying power has suddenly dropped by hundreds of thousands of dollars simply because the interest rate jumped. It's a kind of disappointment that stays with you. And it's not just financial, it's emotional. People feel stuck. They feel like they missed their chance. They feel like they're waiting for a door to open that hasn't budged in months. Even renters aren't spared. Rising interest rates don't directly change rent prices, but they influence the entire housing ecosystem. When fewer people can afford to buy, more people stay in rentals. When landlords face higher financing costs, they raise rent to cover theirs. When demand for rentals spikes, competition increases. The result? Renters feel squeezed from both sides. They can't buy because mortgages are too high, and they can't get ahead because rent eats up more of their income than ever before.
But while interest rates shrink certain opportunities, they can create new ones. And this is the part most Americans overlook. High rates change the strategies of big investors, institutions, and businesses. They change where the smart money flows. They change what becomes valuable. what becomes risky, and what becomes a hidden opportunity. For example, one of the biggest shifts happening right now is the renewed attention on savings and fixed income assets. For years, people ignored savings accounts because they paid almost nothing. High-yield accounts offered tiny returns. Bonds felt useless. People took more risk because safe options weren't rewarding enough. But now, the environment is flipping. Suddenly, savings accounts are paying real interest, numbers people haven't seen in a long time. Bonds and CDs are back on people's radars. Treasuries are becoming appealing again. For the first time in years, you can earn meaningful returns without taking massive risks. That's a huge shift, but many people haven't adjusted to it yet. Then there's the question of investments. Stock markets behave differently in high-rate environments. Growth companies, especially those built on borrowed money or future potential, tend to struggle. Investors become cautious. They look for stability. They look for companies with strong cash flow. They look for value instead of hype. And that means the opportunities today look very different from the opportunities a few years ago. But most people keep investing based on old assumptions. They haven't adapted to the new environment. Even businesses feel the ripple effects. When companies face higher borrowing costs, they become conservative. They cut unnecessary spending. They delay expansion. They rethink hiring. And all of that affects workers. But it also creates openings for people who can solve problems efficiently, who can adapt quickly, and who can help companies operate in a leaner environment. Being able to understand these shifts gives you an advantage. The key thing to understand is that rising interest rates are not the end of the world, but they are a signal. They're telling Americans to think differently, to spend differently, to save differently, to invest differently. They're a reminder that financial environments change, sometimes abruptly, and that the strategies that worked a few years ago may not work today. But the fear Americans feel, the anxiety around debt, housing, jobs, and everyday expenses, isn't irrational. It's rooted in the reality of the moment. Rising rates hit people where it hurts, in their budgets, in their plans, and in their stability. And when people feel like their stability is threatened, they react emotionally. They worry. They question. They hesitate. They try to protect themselves. The real challenge is figuring out how to navigate this environment without letting fear take over. Because fear leads to paralysis. It stops people from taking advantage of opportunities. It pushes them into making rushed decisions or holding on to outdated ones. And in a world where financial environments shift quickly, staying frozen can be just as damaging as making the wrong move. That's why understanding interest rates, not just hearing about them, is so important. When you know how they work, when you understand why they rise or fall, and when you can see the bigger picture behind them, you start to feel more confident. You start to manage your money differently. You start making proactive decisions instead of reactive ones. And importantly, you stop seeing interest rates as something happening to you and start seeing them as part of the system you can navigate. Still, it's essential to remember that everything discussed here is for educational purposes only. None of this is financial advice. Your personal situation is unique, your goals are personal, and your decisions should be based on careful consideration or professional guidance. But understanding the environment is the first step toward making smarter choices within it. As Americans continue to face this high-rate landscape, it's becoming clear that the old financial habits won't work the same way they used to. And that's not necessarily a bad thing. It's a chance to rethink, to adapt, to focus on strategy instead of survival. But before people can do that, they need clarity. They need to understand what's really happening. And they need to see past the immediate fear so they can position themselves for long-term stability. Because at the end of the day, interest rates are just one piece of the financial system. They can create pressure, but they can also create opportunity. The key is learning how to use the environment to your advantage, even when it feels like the world is working against you. As Americans try to navigate this new financial landscape shaped by higher interest rates, something interesting begins to happen.
people start changing the way they make even the smallest financial decisions. They think more before swiping their card. They hesitate before taking out a loan. They second guess whether now is the right time to buy a home, a car, or even something as simple as a new appliance. And it's this shift, this quiet, widespread behavioral change, that reveals just how powerful interest rates truly are. Because interest rates don't just influence institutions or Wall Street, they influence the psychology of everyday people. And when millions of people start thinking differently about money at the same time, you get a kind of national financial mood shift. You feel it in consumer spending. You see it in business decisions. You hear it in conversations among families, friends, coworkers. And even if people don't fully understand the mechanics behind rising rates, they feel the effects deeply enough to adjust their behavior. One of the biggest areas where rising interest rates force Americans to rethink their decisions is debt management. For years, debt felt like a manageable part of life. Whether it was student loans, credit cards, personal loans, or medical bills, most people felt confident they could juggle their obligations. But now, with higher borrowing costs and rising balances, debt has become something Americans fear again. They're not just thinking about what they owe. They're thinking about how fast that debt is growing. And when interest rates rise, that growth becomes painfully visible.
People who once felt okay carrying a small balance now feel stressed over what that balance could become in a few months. Someone who used to make minimum payments without thinking now realizes that strategy could cost them thousands more over time. Others are questioning whether consolidation makes sense, whether refinancing is possible, or whether they need to shift their daily habits to avoid sinking deeper. Rising interest rates don't just create debt, they magnify it. They make the consequences feel sharper, heavier, and more immediate. But the impact stretches far beyond personal credit. Higher rates also affect savings and emergency planning. For years, Americans got used to low-yield savings accounts. Saving money felt slow and unrewarding. Many people didn't prioritize building an emergency fund because the returns felt barely noticeable. But now, savings accounts, especially high-yield accounts, are offering returns that actually mean something. Suddenly, people who never cared about interest earnings are paying attention. They're comparing rates, they're moving money, they're realizing that saving can finally work in their favor again. And this creates a major shift in mindset. Instead of focusing only on cutting expenses, people start thinking about how to grow what they already have. Instead of relying solely on credit to get through a tough month, they start prioritizing cash reserves. There's a psychological comfort that comes from seeing your savings grow at a faster pace, especially in uncertain economic times. And higher interest rates, ironically, help bring that sense of stability, at least for those who can afford to set money aside. This shift also touches investing. When interest rates were extremely low, investing felt simple. Markets soared. Risky assets, crypto, growth stocks, tech startups, looked like easy wins. People felt confident putting money into speculative opportunities because safe alternatives weren't paying enough to make them attractive. But when interest rates rise, investing becomes more complex. People start to question their strategies. They reevaluate their risk tolerance. They reconsider where they place their money. Suddenly, safe investments like bonds and treasuries start to look appealing again. Dividend-paying stocks feel more valuable. Investors begin focusing on fundamentals instead of hype. That doesn't mean risk disappears, it just becomes something people analyze more carefully. And for many Americans, this is unfamiliar territory. They're used to markets that rewarded aggression and punished caution, but this environment does the opposite. It rewards patience, discipline, and long-term thinking. Higher rates also have a major impact on retirement planning. Many Americans were already behind in their retirement savings. Rising rates make their situation feel even more complicated. On one hand, the higher returns on savings can help boost retirement portfolios. On the other hand, market volatility and economic uncertainty make people worry about investing at all. Some delay contributions. Others move their money into safer but potentially less profitable investments. And many simply feel unsure about what their retirement future will look like. But the truth is, rising interest rates can actually benefit long-term retirement savers if they understand how to reposition their strategies. Higher yields on bonds can create stable income later in life.
Lower stock valuations can offer opportunities to buy assets at better prices. The problem is that most people don't get this kind of guidance. They react emotionally instead of strategically, and that's understandable. When the financial environment shifts rapidly, fear often arrives before clarity. The emotional impact of rising interest rates is something that doesn't get enough attention. Money is not just math, it's deeply emotional. It influences identity, security, relationships, and even mental health. When people feel financially squeezed, they experience stress that carries into their daily lives. They worry more, they sleep less, they feel less secure about their futures. Rising interest rates amplify these feelings because they hit people from multiple angles. It's not just one part of life getting more expensive, it's several. And this creates a kind of background stress that influences decisions people make far beyond their finances. For example, some families delay having children because the cost of raising a family feels too high. Others postpone marriage, moving, or taking vacations. Some hold off on starting businesses. Many avoid buying homes not just because they can't afford the payments, but because they feel uncertain about committing to something so big in such a volatile environment. This is why rising interest rates scare Americans, not simply because things are more expensive, but because the uncertainty forces people to hold their breath. They feel stuck in place, and feeling stuck is one of the most uncomfortable financial emotions someone can experience. But while the emotional and practical challenges of higher interest rates are real, there are ways people can navigate this environment without feeling overwhelmed. The first step is understanding what you can control versus what you can't. You can't control inflation. You can't control the Fed. You can't control global events that influence financial markets. But you can control how you manage debt. You can control how much you save. You can control your financial habits, your priorities, and your long-term strategy. One of the smartest moves Americans can make during high-rate environments is focusing on reducing high-interest debt. Even small reductions can save significant amounts over time. Another smart move is taking advantage of the higher returns on savings. Building a cash cushion can help protect you against emergencies and reduce your reliance on expensive credit. And for investors, learning to shift from speculative assets to stable income-generating assets can help balance risk while still creating growth. Even simple behavior changes like planning purchases more intentionally or comparing rates before borrowing can make a big difference. The financial environment may be tougher, but it's not impossible to navigate. And the people who adjust early, who learn how to use this environment to their advantage, often come out stronger than those who simply try to wait it out.
But one of the most important things to remember is that financial environments are cyclical. Interest rates rise and fall. Economies expand and contract. These cycles are natural, they're not permanent. And while high rates feel painful now, they won't last forever. Eventually, the economy will rebalance. Opportunities will shift again. Borrowing will become cheaper. Housing will adjust. Markets will find new growth. And the Americans who understood how to navigate the tough periods will be the ones best positioned to take advantage of the recovery. Still, it's essential to emphasize that everything discussed here is purely for educational purposes. This is not financial advice. Everyone's situation is different, and what works for one person may not work for another. But gaining a deeper understanding of how rising rates affect your life is the first step toward making better, more confident decisions. As Americans continue adapting to this new financial reality, the biggest challenge is not the interest rates themselves. It's the uncertainty, the emotional weight, and the feeling of losing control. But knowledge helps restore that control. Understanding the environment, shifting your strategy, and focusing on the things within your influence can help you navigate these changes with clarity instead of fear. As Americans continue adjusting to the reality of higher interest rates, something subtle but incredibly important starts to come into focus. People begin to question what financial security actually means. For years, financial security was defined by access. Access to credit, access to low mortgage rates, access to loans, access to opportunities that were made easier because borrowing was cheap. Now, with rates rising and the cost of money itself getting heavier, financial security is shifting towards stability, discipline, and strategy rather than access alone.
This shift is reshaping the lives of millions of Americans. People who once felt confident because they could borrow easily are suddenly reevaluating their entire financial approach. They're realizing that the environment that encouraged quick decisions, rapid purchases, and aggressive borrowing has been replaced by one that rewards caution and patience. And this shift isn't simply mathematical, it's cultural. For a long time, Americans operated in a financial world where low interest rates fueled growth, opportunity, and risk-taking. Homebuyers stretched for bigger properties because mortgage rates made the payments manageable. Entrepreneurs started businesses with borrowed capital. Consumers spent freely because credit was accessible. Investors poured money into fast growth opportunities because cheap borrowing created a sense of momentum in the markets. It was an environment that encouraged optimism, but higher interest rates flipped that momentum. Instead of pushing people forward, they put resistance in front of every major decision. That resistance doesn't completely stop progress, but it does slow it. It forces people to think more. It forces them to calculate. It forces them to weigh the difference between what they want and what they can realistically afford. This is where many Americans are feeling the pressure most intensely. Because when the economy slows, people often start to question not only their financial choices, but also their future. They wonder if they'll be able to retire on time. They wonder if they'll be able to buy a home at all. They wonder if it's worth starting a business, changing careers, or making long-term commitments in a financial environment that feels unstable. But despite the pressures, higher interest rates also create clarity. They reveal the true cost of decisions. In the low-rate environment, everything felt artificially cheap. Houses felt more affordable than they actually were. Loans felt less risky. Investments felt safer. Businesses expanded faster than they should have. People took chances that weren't always grounded in strong fundamentals. It created a sense of financial confidence, but sometimes without the financial foundation to support it. Now, higher rates expose the reality behind those decisions. They reveal which companies were relying too heavily on borrowed money. They show which buyers were stretching beyond their means. They highlight which investments were inflated by cheap cash rather than real value. And for everyday Americans, they illuminate the difference between sustainable choices and risky ones. This kind of clarity can be uncomfortable, but it's also incredibly important. Because when the financial environment becomes stricter, it forces people to build stronger financial habits. It encourages discipline. It makes people think long-term. It rewards those who learn to adapt, to plan, and to maintain stability even when conditions are tough. One of the most important areas where this becomes clear is in budgeting. When interest rates were low, many households didn't feel the need to track every dollar closely. Even if they didn't budget perfectly, the consequences were manageable. But in a high-rate climate, budgeting becomes something much more critical. It becomes a tool for survival. People are learning to separate wants from needs. They're identifying the parts of their spending that don't truly add value to their lives. They're making conscious choices instead of impulsive ones. This shift has created a wave of new behaviors. More people cooking at home, delaying travel, choosing used goods instead of new ones, refinancing or restructuring debt where possible, and focusing more on building emergency savings. These choices aren't just about financial pressure, they're about regaining control in an environment where losing control can be costly. And then there's the workplace. Higher interest rates influence job markets in ways most people don't immediately notice. When companies face higher borrowing costs, they slow down hiring. They cut back on projects. They reevaluate expansion plans. This not only affects workers, but it also affects wage growth. Suddenly, raises become harder to secure, promotions become less frequent, job switching becomes riskier, and Americans begin to feel that shift even if they don't fully understand the economic forces behind it. On the other hand, high-rate environments often reward workers who bring efficiency, creativity, and strategic thinking. Companies become more selective, and they value people who can help them operate more intelligently. This creates an environment where skill building, adaptability, and initiative matter more than ever. Workers who understand how to add value in a leaner economy often find themselves in stronger positions, even while the overall job market tightens. But while high interest rates can create stress and uncertainty, they also spark a reevaluation of long-term financial goals. Americans are asking deeper questions. What does retirement look like? How much do they really need to feel secure? What kind of lifestyle do they want in the future? And most importantly, how do they build a financial plan that doesn't collapse when the economy shifts? This is where many people start to realize that financial planning is not something to do only when the economy is strong. It's something to do especially when the economy is unpredictable. High interest rates highlight the importance of having diversified strategies, balanced priorities, and realistic expectations. They remind people that building wealth isn't just about growth, it's about resilience. And resilience becomes even more important when you consider how rising interest rates affect families. Many households are discovering that supporting children, aging parents, and themselves simultaneously, often called the sandwich generation, has become significantly harder. High borrowing costs make college loans more expensive. Home equity becomes harder to tap into. Emergency expenses become more stressful. And families who were already juggling multiple financial responsibilities are now learning to stretch their resources further than ever. But this pressure also brings families together in unexpected ways. People are talking about money more openly. Parents are teaching their kids about budgeting earlier. Adult children are helping their parents understand digital banking and financial planning tools. Couples are having more conversations about long-term goals and strategies. These discussions can be uncomfortable, but they're also foundational. They help families build stronger financial communication, which is something that will benefit them long after interest rates eventually fall. Another area of life heavily shaped by rising interest rates is business ownership. Small business owners, especially those who rely on loans to operate, feel the impact almost immediately. The cost of expansion rises. Inventory becomes more expensive. Cash flow becomes tighter. And businesses that relied heavily on cheap credit are finding that they need to restructure their entire approach. But surprisingly, higher interest rates can also create new opportunities for entrepreneurs. Competitors who relied too much on debt may slow down or exit the market, creating space for more efficient businesses. Customers become more selective, which rewards businesses that offer real value rather than those relying on aggressive, unsustainable growth. Lean, well-managed companies can actually thrive in this environment because they operate with discipline, intention, and clear strategies. In other words, high interest rates don't destroy opportunity, they simply change the kind of opportunity available. But perhaps the most important insight that comes from rising interest rates is the recognition that financial success in this environment is less about chasing fast wins and more about building strong foundations. Americans are learning that steady progress, thoughtful decisions, and long-term planning matter more now than they did during the era of cheap borrowing. They're learning that resilience is just as important as growth. And they're learning that understanding the system, not fearing it, is the key to getting ahead. Still, it's important to remember that all of this is for educational purposes only. This is not financial advice. Everyone's situation is different, and the best financial decisions depend on personal goals, circumstances, and risk tolerance. As Americans continue facing the challenges of a high-rate environment, the most powerful thing they can do is stay informed, stay adaptable, and stay strategic. Because even in the toughest financial climates, those who remain calm, thoughtful, and prepared often come out stronger, more stable, and better positioned for future opportunities. But here's the part most people never realize. When interest rates stay high for too long, they don't just influence the numbers on a bank screen. They reshape behavior. They change how comfortable people feel taking risks. They alter how businesses make decisions, and they quietly shift who gets ahead and who falls behind in the financial food chain. And right now, Americans are not just worried about paying more, they're worried about what these rates signal about the future. A future where financial security might require a completely different playbook than the one they grew up with. Many Americans grew up believing some very classic money rules. Buy a home as soon as you can, take on a manageable car loan, invest steadily, and let time do the work. That worked for decades because interest rates hovered at historically low or moderate levels. That wasn't free, but it was predictable, and that predictability allowed people to plan. Now the ground has shifted. That predictability has evaporated. And when people can't predict what comes next, confidence changes, spending changes, investing changes, and the way people view financial risk changes almost overnight. Think about what's happening psychologically. When interest rates spike, people start second-guessing every major financial decision. A car purchase becomes a debate. A home purchase becomes a dilemma. Opening a business becomes something you wait a little longer to do. Even small things, a vacation, a new appliance, a home upgrade, suddenly feel heavier, not because people don't have the money, but because they're not sure if they should part with it. And that hesitation has consequences.
When millions of people feel hesitant at the same time, entire industries start slowing. Home buyers pause, so sellers pause. Sellers pause, so movers pause. Movers pause, so furniture stores slow down. Furniture stores slow down, so suppliers slow down. It becomes a chain reaction, and the spark that ignites it all is the same: uncertainty. Businesses feel it too. A company might want to expand, hire more employees, or launch a new product. But if borrowing costs triple, executives suddenly hesitate. They worry about margins, cash flow, and whether consumers will keep spending. So hiring slows, expansion slows, growth slows. And even if a recession hasn't officially started, the economy begins behaving as if it's already preparing for one. This is why Americans feel scared right now. It's not just the numbers, it's the ripple effect those numbers create across their entire financial ecosystem. When the cost of money goes up, everything that relies on money becomes more fragile. But here's the thing: Americans are not powerless in this environment. In fact, the people who learn how to navigate high-rate periods are the ones who often come out stronger on the other side. Because high rates, while painful, also create opportunities that simply don't exist during low-rate environments. For example, savers, a group that has been ignored for nearly 2 decades, are finally earning real returns again. High-yield savings accounts, money market funds, and short-term treasury bills are offering real, meaningful cash earnings for the first time in years. And while those returns aren't glamorous, they provide something foundational: stability. The kind of stability that lets people build a cushion, strengthen their finances, and regain some sense of control. That stability is exactly what people need during periods of financial uncertainty. Another opportunity comes from something most people overlook. High rates force financial discipline. They make people think twice before taking on debt. They encourage people to budget more intentionally. They push people to pay closer attention to where their money goes, which ironically leads to stronger long-term habits. Some people discover for the first time how much they were overspending simply because cheap debt made it easy to ignore. And then there's investing, a topic that often scares people even more when rates rise. But what's important to understand is that markets don't react to interest rates in a straight line. They react to expectations. That means when rates eventually peak, or even begin to approach a peak, markets start pricing in the future decline long before it actually arrives. Investors who panic during high-rate environments often end up selling low right before recovery begins. On the other hand, investors who remain calm, consistent, and strategic often find that high-rate periods create some of the best buying opportunities because uncertainty tends to push prices down, even for strong companies. But the biggest opportunity, and the one that will matter most for the future, is awareness. High rates force people to become more financially literate. They force people to understand how money works. They force people to ask questions. Why does the Fed raise rates? How does inflation actually impact my life? What does refinancing mean? How does compound interest help or hurt me? What's the difference between good debt and bad debt? When people start asking these kinds of questions, they start gaining power. Financial knowledge is not just information, it's armor. It protects you from making emotional decisions. It protects you from panic. It protects you from being caught off guard. And if there's one thing Americans need right now, it's protection. Not in the form of hiding from the economy, but in the form of understanding it. Because the truth is this: interest rates are not inherently good or bad. They are a tool the Federal Reserve uses to slow the economy when it's too hot and to stimulate it when it's too cold. A tool that affects everything from credit cards to mortgages to job growth. A tool that can feel painful in the short term, but can prevent much deeper problems in the long term. Knowing that doesn't make interest rates easier to deal with, but it does make them easier to understand.
And when you understand something, you fear it less. Now, let's shift to something extremely important, maybe the most important element of this entire discussion: how regular people can adapt. Because while you can't control interest rates, you can control your response to them. First, people need to build flexibility into their financial lives. That means not overextending, not betting on perfect conditions, and not assuming that a low-rate environment will magically return tomorrow. Flexibility means keeping your budget lean, maintaining some cash reserves, and being realistic about what you can afford. Second, people need to prioritize high-interest debt. Credit cards, adjustable-rate loans, and variable interest lines of credit become significantly more dangerous when rates rise. These should be actively managed, either paid down or refinanced before they snowball. Third, people should take advantage of the high-interest environment where it benefits them, parking cash in higher-yield accounts, laddering treasury bills, taking advantage of employer-sponsored retirement matches. These may not feel exciting, but they build financial resilience. Fourth, people must remain cautious about big purchases. A home might still make sense if it fits your long-term goals, but you should never feel pressured to buy simply because others are doing it. The same goes for cars, renovations, or other major commitments. When rates are high, patience becomes a financial asset. And finally, people need to stay informed. Not obsessed, just informed. Watching economic indicators, understanding how rate changes work, and knowing what to expect can make the difference between panic and preparation. Because here's the reality: interest rates are not going to stay high forever. They never do. The economic cycle always turns. The question isn't whether conditions will change. It's whether you'll be prepared when they do. And that brings us to where you, as the viewer, have the ultimate advantage: awareness, strategy, and time. As long as you stay educated and intentional, you can navigate this environment without fear and possibly even come out ahead. Now, as we wrap this entire discussion together, remember this: Americans aren't scared of interest rates because they're weak or unprepared. They're scared because the system changed faster than anyone expected. But every shift in the economy creates winners and losers. And the winners are almost always the ones who adapt early, learn quickly, and stay calm. High interest rates might be uncomfortable. They might be frustrating. They might even feel unfair. But they are temporary, and how you handle them can permanently strengthen your financial position. So stay aware, stay strategic, and stay confident. Your wallet might feel pressured today, but with the right understanding, you can turn this moment into an opportunity instead of a setback. And one final reminder: this entire video is for educational purposes only and is not financial advice. Always do your own research or speak with a professional before making financial decisions.